Current price 0.22 USD. Market movement minus 0.69 USD, minus 75.85% intraday. When you look at a screen and see a stock trading at 22 cents, down nearly 76% in a single trading session, you are not just looking at a red number. You are witnessing a catastrophic repricing event that defies the typical laws of supply and demand observed in standard blue-chip equities. Oriental Culture Holding, ticker symbol OCG, is currently changing hands at exactly 0.22 USD, having erased 0.69 USD from its value today alone. To put this into perspective, for every dollar of value this company held at yesterday's close, roughly 3/4 of it has evaporated into the ether of the market, pre-market, and intraday session. This isn't a correction. This isn't a dip. This is a liquidation event that forces us to question the very mechanical structure of the order book right now. Most investors opening their Fidelity mobile app or checking their Robinhood app this morning likely expected volatility given OCG's history, but few anticipated a move of this magnitude. The expectation for a stock that hit highs of over $19 just days ago is that it might retrace, perhaps find support at $5 or even $2. The reality, however, is far more brutal and instructive. The reality is that the floor has not just fallen out, the foundation has been excavated. We are seeing a complete capitulation of the bid side, likely driven by a specific fundamental catalyst that we will dissect shortly. While the average trader might look at this and see a bargain, the institutional eye sees a massive liquidity trap. This disconnect between the buy-the-dip mentality and the structural solvency of the stock is where fortunes are either made or, more likely in this specific case, completely annihilated. To understand why OCG is trading at 22 cents, we have to look away from the charts for a second and look at the filings. The narrative here has shifted from a speculative momentum play to a dilution story of epic proportions. When a company the size of Oriental Culture Holding, a microcap by all definitions, files for a capital raise or an at-the-market or ATM offering that dwarfs its current market capitalization, the math becomes undeniable. The market is pricing in a flood of new supply. It is the economic equivalent of a central bank printing $1 trillion overnight. The value of existing currency, or in this case, existing shares, must adjust downward to account for the new volume. This is not Apple stock adjusting for a slight miss in iPhone sales. This is not Tesla stock reacting to a tweet. This is a fundamental restructuring of the share count that leaves early investors diluted to a fraction of their original ownership. Let's pause and consider the environment where this trade is happening. If you are using Interactive Brokers trading platforms or the Interactive Brokers platform generally, you are likely seeing a volume spike that is exponentially higher than the 10-day average. This indicates that high-frequency algorithms and day traders are churning the float, playing the volatility rather than investing in the business. In the world of online investment, specifically for those engaging in self-investing without the guardrails of investment help or an intelligent portfolio, this is the most dangerous water to tread. A 75% drop often invites speculators who believe it can't go lower. The harsh lesson of the market, which seasoned traders on Fidelity Investments platforms know well, is that a stock down 90% is just a stock that was down 80% and then got cut in half. OCG at 0.22 USD is not merely cheap, it is priced for an existential risk. The expectation was that Oriental Culture Holding, dealing in the collectibles and art market in China, would leverage the post-pandemic reopening and the digital asset boom to grow its revenue. The reality is that the company has become a vehicle for extreme financial engineering. The gap between the business operations, selling paintings, coins, and stamps online, and the stock's behavior is a chasm. When you trade on investing sites or through an individual brokerage, you often assume that the price reflects the business health. Today, at 0.22 USD, the price reflects only one thing: the sheer weight of paper being sold into the market. It is a supply-side shock. Now, let's widen the lens. How does this compare to the broader ecosystem of online investing? When you look at Schwab Intelligent Portfolios or Fidelity Wealth Management, the goal is capital preservation and steady growth. Those algorithms explicitly avoid tickers like OCG because the beta, the volatility relative to the market, is unmanageable. However, for the retail trader using SoFi Invest or Robinhood stock trading, these tickers appear on the top losers or highest volume lists, acting like a siren song. SoFi Investing Tools and SoFi Stocks lists often highlight these movers, and it draws in capital that is looking for a lottery ticket. But unlike Nvidia stock, which moves on earnings and AI demand, OCG is moving on market structure dynamics. If you are sitting in Fidelity IRAs or holding Fidelity mutual funds, you are insulated from this. But if you are in a Robinhood cash management account looking to deploy capital quickly, you might be tempted. This is where you must exercise extreme caution. The drop to 22 cents also raises the specter of NASDAQ compliance. Major exchanges have minimum bid price requirements, typically $1. Trading at 20% of that requirement puts the stock in the danger zone for delisting. A delisting notice would force the stock to the OTC markets, where Robinhood crypto traders might be familiar with volatility, but where liquidity dries up for equity investors. Interactive broker stock trading accounts often allow OTC access, but many standard Fidelity brokerage accounts restrict or warn heavily against it. This adds a layer of regulatory risk to the market risk already present. Let's talk about the business itself, assuming for a moment that the price is distinct from the company. Oriental Culture Holding operates an online platform for artwork and collectibles in China. Their business model is essentially an e-commerce facilitator for cultural goods. They connect artists, dealers, and owners with investors and collectors. In theory, this is a sound model. The Chinese art market is massive. Historically, tangible assets like art have been a hedge against inflation. However, the company's financial reports have often shown inconsistent revenue streams and operating losses that make Fidelity ETFs look like risk-free assets by comparison. When you engage in invest online activities, due diligence requires reading the 10K and 6K filings. OCG's filings often reveal a company that is struggling to generate consistent cash flow, necessitating these massive capital raises that destroy shareholder value. If you were a user of Robinhood fractional shares, you might think, I can put $10 in and get 45 shares. Why not? The why not is the opportunity cost. That same $10 could go into SoFi ETFs or a diversified SoFi robo-advisor account where the downside is managed. Or it could go into interactive brokers' fees, which are low, allowing you to trade options on more stable assets. The allure of the 0.22 USD price tag is a psychological trap. It mimics the penny stock dream, where a stock goes to $1 and you make 400%. But for OCG to return to just $1, it would need to rise nearly 350% from current levels. Stocks that drop 75% in a day rarely recover that ground in a straight line. They usually face months of overhead supply. Investors who bought at $0.50, $0.80, or $1 who are desperate to sell the moment the price ticks up, creating a ceiling that suppresses any rally. We need to address the pump that preceded this dump. Just days ago, OCG was trading significantly higher, reaching levels that made no fundamental sense relative to its earnings. This is a classic pump and dump cycle often seen in low-float stocks. Speculators, perhaps coordinating on social media or reacting to momentum signals on their Fidelity trading platform, drive the price up. Once the momentum stalls or the company announces a financing deal, the dump, the exit door becomes too small for everyone trying to leave. Interactive brokers account holders who were shorting the stock at $10 or $15 are currently sitting on massive profits, while long-only retail investors are holding the bag. This dynamic is central to the expectation versus reality theme. The expectation was a squeeze, the reality was a rug pull. Comment below how many shares of OCG you currently hold, or if you managed to get out before the drop to 22 cents. Are you looking to average down, or is this a tax loss harvest for you? Let me know in the comments. Moving forward, what is the outlook for Oriental Culture Holding? We are likely to see one of two scenarios. Scenario A, the company completes its offering, stabilizes its cash position, and the stock trades sideways in the 20 to 30 cent range for months, eventually executing a reverse stock split to regain compliance. This is a common tactic. A 1 for 10 or 1 for 20 split would bring the price back up to $2 or $4, but it doesn't change the value of your holding. It's purely cosmetic. Scenario B, the stock catches a dead cat bounce. Traders on Robinhood investments platforms love a bounce play. The stock might